Welcome to the Dealmakers Podcast, sponsored by Dealmakers Institute. This podcast is dedicated to exploring and uncovering exciting deal-making truths with those who are making it happen every day. You'll discover ways to leverage and profit from every aspect of the deal-making pipeline, from acquisition to exit. And now, the founder of Ribbon Equity and one of the leaders at Dealmakers Institute, your host, Ben Claremon.
Hi, welcome back to another episode of the Dealmakers Podcast. Today we have Ben Claremon, who is actively involved in the public space, public equities at that. And today we'll be diving into the outlook of this space and how private equity falls into place. So without further ado, I welcome Ben to the show. And Ben, can you give us an overview of your background and what you've done and accomplished so far?
Sure. Thanks so much for having me on. I'm interested in this conversation because you and I, while we exist in the same universe, we kind of travel in different galaxies, and it's interesting to see how there's some overlap in what we focus on. So I'm interested in hearing your thoughts on all of that. So I'm Ben Claremon. I'm a principal and portfolio manager at Cove Street Capital. Cove Street is a long-only asset manager, which means no shorting, no options. We just buy stocks in the public market with a U.S. focus. Small and SMID is really our world, and we hold them for the long run. We are typical Warren Buffett style investors. Buy good businesses, hold them. Take advantage of compounding, take advantage of the tax efficiency of not selling, and just try to buy businesses that are getting more valuable every day. I didn't start my career in equities. I wasn't one of those guys who, I was at 15 years old. I'd already read all of Warren Buffett's letters. I had a more circuitous path to investing. My family's in the commercial real estate business. So after I graduated from the University of Pennsylvania, I went into the family business. And that was a unique experience. I think anyone who's worked with their family knows that it's a mixed bag, lots of good things and lots of, kind of interesting familial, things that come up over time. And so it was in the midst of kind of doing some soul searching about whether I wanted to do that for the rest of my career that a good friend of mine, handed me a copy of Benjamin Graham's book, The Intelligent Investor. It is a little bit of a cliche within the value investing world because this book is like so ever present in a lot of people's minds, but it literally changed my life at least in terms of the career track and perspective. I read that book and I said, I was a value investor before I knew what a value investor actually was. It was in my DNA. And so I made a decision in the mid 2000s to leave the family business and go into a career in investing. So lucky enough to get a job at a hedge fund in New York in the kind of the 2007 timeframe. Lucky and unlucky at the same time, in the sense that this was right before the financial crisis. It was a very difficult period for any firm to raise assets during that time. So in 2009, as the firm, my first couple firms I was working for were kind of winding down, decided to go to business school. So I went to the business school, UCLA, made my way back to the West Coast. I'm from Arizona originally, so was happy to be back on the west side of the country. And, it was a difficult period in the job market, right? It was when I graduated in 2011. It wasn't as bad as it was in 2009, but it was, still pretty bad. And to stay in the game, while I was in business school, I'd started a blog called The Inoculated Investor. And if you have ever watched a live stream of the Berkshire Hathaway annual meeting, where you can sit on your couch and listen to what Warren Buffett and Charlie Munger say about the world, that did not exist in the early 2000s. The only way you could have any sense of what was discussed at the meeting was someone had to sit there and take notes. And so that was me. I made the crazy decision that I wanted to try to take down every word that Buffett and Munger said. And I launched the blog with that content. and the rest is history. And I've developed a following in the value investing community, and I still have a lot of people who know me from that. But I always wanted to be a securities analyst. I didn't really want to be a blogger. And so very fortunate for me, when I was looking for a job coming out of business school, I got an email from a guy who said, "Hey, I'm starting a firm. We should talk." And I had no idea who he was, but apparently someone who followed my blog and knew I was looking for a job recommended me. And so that's how I came to Cove Street. And we're almost 10 years in. It's been an interesting ride for value investors, but learned so much. Have the privilege of being a portfolio manager and getting to, live the dream.
Absolutely. Great. Great overview. And then we wanted to dive into some of the outlooks and recommendations of how you or your firm look at companies in the public space. You mentioned that your firm is more so of a value investor. So in today's highly elevated valuations of publicly traded companies, what does value investing mean in today's term?
That is a fantastic question, and there's been a lot written about this recently. What is value investing? Howard Marks of Oaktree just wrote a long piece of, trying to compare and contrast value investing and growth investing, and Cliff Asness of AQR. There's been a lot written about two questions. One, is value dead? And two is will value ever, what is known as value ever outperform growth? And so these are things that are impossible to answer, and there are people who are way smarter than me that write about them. But I mean, what I can talk about is what we see on the ground, and how that compares to previous periods. And so, if you go to covestreetcapital.com, you can see that we've written a fair amount about this, the subject of what we're seeing right now. We're not macro investors. We don't spend our time really worrying about, where the S&P 500 is trading, because that's not our world. We're small cap investors in general. But even outside of whatever craziness we're seeing with Tesla, or what are known as SPACs, or IPOs going up 100% every day, these things that you saw in the late 90s, there's just a lot of speculative fervor out there. And it's not just in the S&P 500 or in the FANGs or in Tesla. Like the things that we see, in small and micro cap, these businesses that, whether they have no earnings or, just trade or don't generate any cash, but are whatever the hot new thing, or that are growing, you trade at multiples that we would never consider, but that it's almost hard to justify the math unless they're gonna own the entire end market in a few years. So there's all of that means that there's there's a lot that we have to stay away from. But I will say the nuance is, even the really good businesses, the Buffett-like companies that we like to invest in, have seen significant multiple expansion over the last few years. And I think I'm not going out on a limb to say that low interest rates are driving valuations up. If you have very low treasury rates and there really is no alternative to stocks, good quality Buffett style businesses that aren't growing 20 or 30% every year, but are growing 3 to 5% every year with good moat and good margins, those things trade at, I don't know. I mean, the things that you should trade 11 to 12 times EBITDA and call it 18 times earnings now trade at 17 times EBITDA and 30 times earnings, right? And so, I think there's a fair amount of speculation about how good the future is going to be that has pulled forward returns in a lot of stocks. And so what that means, I think, is that you have to be highly, highly selective about what you invest in. And we're concentrated investors, so we have the ability to, invest in those needles in the haystack. And so here's where we're still finding opportunity. So, I mean, I think broadly markets are expensive. I think there's crazy speculative stuff happening in the growth world. But that's not our world. So we are, we would never look at those companies, but where can you find value still? So there's a huge, what I would call anti-incumbent bias. So I guess if you think about the model of tech companies and apps and how they've disrupted the world, just think of Tesla and taxis, right? The taxi cab industry had this basically government mandated or allowed monopoly over the transportation, individual transportation business, and through taxi medallions, taxi drivers were allowed to, they limited the supply of medallions, so basically the taxi drivers had pricing power. Well, Tesla, sorry, did I say Tesla? I meant Uber. I don't know why. If I said Tesla, I apologize. Uber and taxis. And so Uber came in and basically disrupted that model. Uber and Lyft disrupted that model. So, there's this idea that tech, software is eating the world, and that there's going to be an app that disrupts everything. And what that means is that the incumbent in any industry you can imagine is under threat. Right. And is that legitimate or is that not legitimate is really the question, and where deep quantitative and qualitative analysis is required to determine whether the new venture capital funded competitor du jour, right, is actually a major threat to the incumbent or not. And so I think what we've seen is that there are opportunities to invest in businesses with global brands and global moats that people are sure are going to be disintermediated. But it's just because there's something hot and growing, in one corner of the market, and people are ignoring, network effects, billions of dollars of infrastructure, and businesses that are willing to cannibalize themselves. So, if I had to think about where we have found value recently, it is assets that are, either segments or whole divisions or whole companies that are just undervalued because of the fear of kind of disruption, and disruption that we think is really overstated by the market. So, summing up a little bit, it's like there are pockets of value. I don't know if we could own 100 good ideas. I don't think there are 100 good ideas out there in small and mid cap right now. But could you own 20 to 30 in SMID and kind of 30 stocks in small cap? Yeah, and that's where we're still, that's why we're still finding opportunities and still putting capital to work.
Great. And that leads me on to kind of like the next subject, right? We've talked about value and how value investing has transformed over the last couple of years. So with value investing, there has to be a sort of hedge for risk. So with the disruption of a lot of traditional businesses, mainly from our lens, we see manufacturing and healthcare are primarily going to be disrupted in the next couple of years for a number of reasons. One being manufacturing now has the ability to increase their efficiencies via adding new technologies such as AI. So AI is, of course, artificial intelligence, and there's a lot of applications that are currently being developed to help increase efficiencies in the manufacturing space. So with these new technologies and applications that are designed for helping or increasing companies, right? Some companies may adopt the technology faster than others, but mainly as you're looking through your lens, how are you hedging some risk involved in the small cap space, mainly traditional industries?
Yeah, that's a great question. And we have this mantra at Cove Street is that we will buy cyclical problems, meaning something, whatever, a business is hurt temporarily, whether it's by COVID or other cyclical elements, but will bounce back. And we don't want to buy secular problems. Secular problems are long-term problems that are, that as you discussed, some kind of disruption to the industry that changes the whole dynamic, that changes the industry structure, that changes the margin structure of the company. And we want to avoid those things. Now, as I was just talking about, the market right now assumes a lot of businesses have secular problems, and many do. But that doesn't mean the market's always right. And the market, I think, assumes a secular problem, and then and shoots the incumbent. And sometimes that's justified, and sometimes that's not. So the way we manage risk is two ways. One, I think we avoid things that have clear secular problems. So value investors, and I would include myself, and at times during my career and even now, we get seduced by low multiples, whether that's a low multiple of EBITDA, or a low multiple of earnings, or a really attractive, DCF, discounted cash flow analysis. You get seduced by these low multiples and some things that are, quote unquote, cheap. And cheap these days, I think, and maybe it's always been true, but I think really true right now, that cheap can be cheap for a reason. And so, just because something has a high free cash flow yield, or pays a high dividend yield, or has trades at a low multiple, I think you have to have a very clear sense of why your view about the secular trend is differentiated from what the market's is. And you have to do a lot of due diligence on a qualitative side to really determine that it's not a secular problem. And so as I've discussed, like, this anti-incumbent bias in the market, we are passing on a lot of things that we would say, hey, this looks cheap. They look like they have a good industry position. It's unclear whether they're being disrupted. Let's start to do some work on it. And as we dig in, we say, yeah, you know what? Maybe the market's right about this, and maybe it's even expensive where it trades now. So that's one way to hedge. The other way to hedge, I think, our risk or limit our risk is position sizing, right? So, the future is uncertain, and assuming that a business or an industry is going to be disrupted because a hot new tech company is taking aim at an industry, in a lot of cases that, in recent times, that has been it's good to bet against the incumbent. And a lot of cases, I think it's overstated. But you don't want to bet your whole portfolio on, either just owning all companies that are under secular threat, or having, individuals, companies that have a large position size. So I think what we've done is we've limited the position sizes of things where there is the market has perceived a secular problem, but we totally disagree with that statement. We're not going to make that, 15% of our portfolio. It's more going to be like a 2.5% of our portfolio. And we continue to do due diligence with the idea of finding disconfirming information. So what does that mean? So if our hypothesis is that a specific business is not being disrupted, and that it has a moat and network effects and competitive advantages that dissuade and repel disruption, if we find evidence that disconfirms that belief, we have to be willing to say we were wrong. And so I think we would be quick to sell something for which that, and we're long-term investors, but when you find out your original hypothesis was incorrect, you have to be quick to get out. And so I think those are the ways that we try to mitigate risk. It's treacherous out there for value investors. So with insurance, there's this idea of adverse selection. And I often joke about, value investing these days being an endeavor in avoiding adverse selection. So adverse selection in insurance is the idea that as an insurance company, you don't want a pool of all the people who somebody else wouldn't insure, because that probably means that they've got, if it's a health insurance company, that means they probably all have health and, pre-existing conditions, and they're going to be expensive people to insure. So in some ways, if you're looking through the pool of quote unquote value stocks, it is like, everything that the market has left behind. And if the market is right about that, then your pool is not going to be a particularly profitable one. So what we're trying to do is we're trying to find things that the market is underappreciating, for any number of reasons. That's what we're always looking for. But I would certainly agree that right now, you have to be really careful about, selecting from the quote unquote value pool.
Yeah, absolutely. And I want to dive a little deeper into your qualitative analysis, given that we're in a sort of a new frontier in a way of uh, value investing, right? There's an increased amount of the spotlight has definitely increased in certain areas such as does the company invest in eco-friendly solutions, things of that nature. So there's more so a lot of um, social awareness in investing. So I wanted to know what has Cove's three. Apologies if I mispronounce. So wanted to know what your firm is doing in terms of building that into your analysis.
Yeah, that's a great question, because the ESG, environmental, social, and governance investing has become a hot trend, and we, whether regardless of what we think of ESG investing as a whole, which I will make a comment about, but we understand that it's really important, and I will say one thing about ESG. I am a total believer, and maybe my views are not shared by everyone at my firm, and we have slightly different views. But I'm a devotee of the idea that businesses should be taking into consideration all of their stakeholders, and that includes shareholders, right? That doesn't mean that it doesn't mean that you only focus on whatever customers or employees at the expense of your shareholders. It's a balance. Just like anything in life is a balance. And so, I'm a total believer in that. But what we see in the ESG world is, it's a marketing strategy now, right? People are looking for it. And so firms that were never really interested in ESG, all of a sudden have ESG products, and they own a lot of the same tech companies within these products. And I mean, I guess it's from an environmental perspective. Yeah. I mean, Facebook's not out there, polluting the world with fossil fuels, but question what is how much damage has Facebook done in the world elsewhere, right? And how does that fit within an ESG framework? My point is not to pick on Facebook. My point is to be like, it is just a really interesting, and it's very difficult to determine like what is actually ESG friendly and what is not. And so we've been corporate governance focused investors from day one. And so the G part has always been the most important part for us. And it's not because E and S don't matter. It's because without a G, without good governance, you don't get E and S either. And that's our baseline. If you don't have good people running the company, because companies are not just, they're not just pieces of paper and stocks that trade on an index. These are made up of people. If you don't have good people running the company, you're probably not going to be caring about the environment. You're probably not going to be caring about your stakeholders, and you're probably not going to care about having a socially sustainable company. So we focus on what we think that we're pretty good at assessing, and through our diligence process, we try to learn a lot about, and that's the people running the company. So, we are not what we would call activist investors. We have been activists at times. We have, meaning that we have, we have publicly denounced certain activities at companies and tried to create change, but that's not in our DNA. Really, we would prefer to invest in businesses run by people who understand capital allocation, who care about corporate governance, and who also run businesses that are getting more valuable every day. And if that happens, we can just let those leaders and those businesses, let them do their thing without needing input from us. So I think our lens on this is pretty simple. Is like, understand who you're partnering with, understand their incentives, understand how they view the other stakeholders in the business other than the shareholders, and then you make an assessment about whether these are the kind of people that you would want to partner with for the long run. And so that's where we have a very large, checklist of things that we look through. And as we're assessing people, I teach a class, not a course, but a class on corporate governance and capital allocation and assessing management at the UCLA Value Investing Program every year. And one of the things I tell the students every time, inevitably, is assessing people is really, really hard. It's like easy to determine. Most cases, it's easy to determine, what multiple of business trades at or what the return on invested capital is. But the people side, understanding their incentives, understanding how they think about capital allocation, understanding what they're going to do in a stressed environment, that's really hard. And you're never going to know everything, but you have to do a fair amount of diligence to trust that when things are either going well or going poorly, that these people will act on your behalf. And so that's where we spend our time. I'm happy to see a lot of our companies moving more towards a sustainability focus, because I think sustainability from an environmental perspective is good for the world and good for business, right? If you are using less water, if you're burning less fossil fuels, if you are reducing waste, what does that mean? It just means you're more profitable. So this is not an either or in my mind. It's not like, well, you're either being conscious of how you run your operations or you're profitable. It's both. You're conscious of how you operate, you reduce waste, you reduce water usage, and all of a sudden you're more profitable. And if you care about your people, it's even better, because if you listen to any company, one of the worst things for them is turnover. They train someone for 2 years, and that person leaves because it's a bad culture or there's no room for opportunity. Right, that's a cost, and then you have to train another person. And what if? And it's costly, and turnover is not great. So what you want is a company that has an inclusive culture that allows people to work there for 30 years or their whole career, and that sounds to me like a sustainable business. So these are people throw out a lot of acronyms, and there's this hot ESG thing where everyone wants to get on board. We like to think of it as we focus on corporate governance, and that covers all of the other things that we care about as well.
Yeah, absolutely. I think it's definitely one of those topics that is that's currently hot right now. But like you said, the G, everything else kind of centers around the G, right? So with that being said, let's switch gears a little bit. We wanted to dive into how private equity can benefit or provide value to the public space. So earlier we talked about there's a lot of SPACs that's going to market. There's quite a few IPOs, but those are of course at multi-billion-dollar level. So a private equity firm such as Ribbon Equity, which we mostly focus on adding value to middle market companies. And given your background, let's kind of discuss how those two roads can meet to provide massive value in the market.
So, when people think about private equity, I think they really think of like large buyout. So this is when KKR or Apollo raises a $20 billion fund, and they're looking to buy, either large stakes in companies or buy out completely, either public company or private company, lever it up and, generate returns and pay down debt for 5 or 7 years, and then, take it public or sell it to another private equity firm, right? Like that's what people think of when they think of broadly the private equity world. But I mean, there's an entire world in middle market and smaller private equity that I think is less well trodden, and I think there's more room for inefficiency there, because when you're competing for large public buyouts large buyouts of public companies, you're competing with other strategic investors. The companies are well known by the buy side and the sell side, and so the pricing, I think, is more likely to be efficient. And as a result, especially recently, the prices that you have to pay are higher. And if you're paying too high a multiple and you're putting too much leverage on the business, as a result of how much you have to pay, I think there's just a risk that the returns in large buyout are not going to be as good as they have been in the past. Now, I think you can bifurcate the market and say, well, what about, kind of small and micro cap PE? Like, let's say that you're a private equity company that's not going to raise, 20 billion. Let's say that you're going to cap your fund at $1 billion and you're going to focus on small and micro cap public companies. And from our perspective, given that we live in that world, I think there's an enormous opportunity to buy out what I would call orphan public companies. These are businesses that, for whatever reason, don't get the love from the market, and a lot of it has nothing to do with the quality of the business. It can be something structural, like it's 60% owned by an individual, and only 40% owned by the market, and so there's no liquidity, and so people have a lot of trouble getting in and out, and it's not interesting for institutional investors. Or it's a $70 million market cap company that's a good business, but it's just never going to be big enough for a larger investment firm to actually be able to invest in. And so these companies become orphaned in my mind, and they're just they don't belong in the public markets. Our research suggests that $3 to $4 million a year in public company costs can be ripped out of a company like this. And if you have a 70 million market cap and you could rip out $3 or $4 million in just public company costs, I mean, that's an enormous advantage for the buyer. So we like to think of investing is that you want to look for things that are underloved, underappreciated, and you want to fish in a pool where there are things that could be undervalued. And, in the large cap buyout space, like it seems like a much harder world to create value as a private equity sponsor. But, and it's kind of, and one of the interesting things is, and this is going to be, controversial, and it may not, and of course I'm generalizing, but in some cases, you can probably get a better deal as a private equity business buying out a small orphaned public company than buying a private company. Because in a way, the stock market prices the stock every day, right? And it gives you it gives other shareholders a sense of the shareholders a sense of the value. So if you're a private equity company and you come in and you give them, a premium to that value, they might be willing to sell. On the flip side, if it's a private business and there's a single owner, he or she's not getting a stock quote every day, and he or she may have a sense of what the business is worth. That may not line up with what the private equity company thinks, and so no deal happens. But in the public markets, you can force a deal, right? You can tender for some of the shares as as an investor. You can make an unsolicited offer that the board, and if the board ignores it, you can take it to the shareholders. So in a way, there's a whole space of companies that I would say don't belong in the public markets anymore. They're highly unlikely to ever get the valuation they would deserve. So why wouldn't you, as a smaller private equity firm, why wouldn't you focus there, right? And see if you can avoid paying high multiples, because it's just, whether you're in public equities or private equity, the price you pay really matters when it comes to your ultimate return. And so I like the idea, and there are some kind of hybrid long only / buyout firms out there that kind of employ this tactic where they will, they'll buy the stock, they'll kind of try to take an active role in forcing the company to sell or to do some kind of capital allocation change, and if not, they call capital from their partners and they just buy it out, and so they're able to create their own catalyst. And so, it just seems like an obvious place for private equity firms to be more aggressive, because I just think that there is languishing value in the small and micro space that is kind of going unrecognized.
Yeah, absolutely. I think there's a lot of value there. My next question is, given that this space is seemingly almost wide open, why is it that a lot more private equity firms are not focusing on the medium and small cap space?
Well, there are thousands of private equity firms out there. So I will say that, you can't say that no one's focused on that. So I just want to be clear that I am generalizing a little bit, but I think it's the same thing that happens in the public equities world, right? If you can raise 20 billion, why would you raise 2 billion? Why would you raise $1 billion? Right? There is an incentive especially for the bigger guys to raise larger and larger funds, and that basically means that you can't invest in smaller things. And so at Cove Street, from the very beginning, we are small and mid and micro investors, and we've always said that we would limit our asset size. And the reason you do that is because you can't run $4 or $5 billion as a small cap investor. You just unless you're gonna own 15% of all the companies that you're investing in, or have to run super concentrated. You can't really do that, because you're not gonna be a small cap investor anymore. You're gonna have to invest in bigger things, and you might miss all the the littler things that are a little more inefficient. So I think to some degree it's really about limiting your asset size. And firms, and this is, I'm going to take a shot at our industry as a whole. Firms have incentive to get bigger, and to some extent that comes at the expense of returns. Size is the enemy of returns. Why is Warren Buffett have so much trouble putting money to work now? Because he has billions and billions that he needs to put to work. He's not buying 100 million market cap companies that could double or triple, because it doesn't move the needle. And so the size is the enemy of returns. And so if there's just so much appetite from institutional investors to give private equity sponsors the money, I mean, I don't blame them for raising larger and larger funds, but I would say that that leaves room for people who are willing intentionally to limit their asset size, to focus only on small and micro public companies, and even private companies as well, and just fish where there's a lot of fish, as opposed to fishing where there's a bunch of other fishermen and only a couple fish.
Great. That's a great answer. And especially at Ribbon Equity, our main goal is to provide value to the middle market space, right? So, as you know, there's a tremendous amount of wealth that's being transferred, and that's mainly due to baby boomers, having to make two unfortunate decisions, especially during the trying times that we're living in right now. So one of those decisions is to put the business up for sale, and that decision is primarily being led by their lack of succession plans in place. So that means either the next generation don't want to take over the business, or have no interest in the business as a whole, right? So, and then the other decision is having to close up shop. And unfortunately, COVID-19 has expedited those decisions. So, as a private equity firm or a private investment company, there is a huge opportunity to add value to the companies via acquiring the company, helping the companies grow and scale, and also strategies such as roll-ups, and a strategy called agglomeration is ultimately rolling up the companies in a way to ultimately put them on the public market. So that will ultimately fall within your space. So there's a lot of strategies in play, and one of the strategies that we do want to dive deeper into this conversation is exactly what you said is um, actually raising a fund or talk about um, the possibilities that's out there in this medium and small cap space, because it really seems like a great idea, because um, a lot of those companies are probably much better off in private hands. Would you agree?
Yeah, I mean, especially kind of dovetailing what you're talking about. Let's say, that same dynamic that you have in private businesses, you have in public companies as well. I mean, you have these entities that are controlled by families. These are public companies, and who knows if there's any succession plan. Now, a public company is not just going to close up shop, but that doesn't mean that there's a good succession plan. That doesn't mean that, the kids want to work in the business, and there could be that transfer of the business to other hands. And many times what you see is that the old guard maybe didn't invest in the business the way they should. Maybe they didn't move with the markets or the technology. And so in a way, you don't want to do that transformation in public. This is a generalization, but it's usually true that if you're going to do some kind of major change to your business, whether that's like ripping out your systems and putting in a new, ERP system, or, investing aggressively in technology that you're behind in investing in, it's going to be really hard for public investors to tolerate that. And it's not that, and it's not that you shouldn't do it. It's just the public investors are going to punish you for it. And so in a way, as a private equity sponsor, what you would do is you'd buy out these businesses with the idea of investing in them in the short run, helping them transform themselves, kind of outside of the public's gaze, and then bringing it public again, maybe with, added some, you've made some acquisitions on top of it, and you've transformed the business. Maybe margins are better. Maybe you're going to get a higher multiple on an exit. So I think there's a lot of room. It's not just a transfer of wealth, and so you need to find someone to run it. It's more like there are operational improvements that could be made, and technological improvements that could be made that could make the business more valuable over time. And so, having an outsider put his or her eyes on it, especially outside of the public's purview, I mean, I think you can add a lot of value there.
Yeah, absolutely. And speaking of adding value, of course, right now the EV to multiples, EV to EBITDA multiples are really climbing in the public space. So, um, given that we're talking about this strategy currently, um, how would you best, I guess, advise a private equity firm um, to take advantage of climbing multiples, but also pricing the deals accordingly?
Yeah, I mean, I think what you're going to see in 2021, now a lot of venture-backed companies are going public, and so that's part of what you're seeing. You're seeing venture investors cash out, and especially given all of the, the enthusiasm for IPOs, it's a great time to be exiting businesses. So I think what you're going to see, is continued private equity businesses exiting positions in the public markets. Right. There was this idea that not even that long ago, last year at this time, that public markets were shrinking and there's going to be fewer and fewer public companies because it made more sense to stay private, whether you were VC backed or, private equity companies would hold things, would not take things public. And then all of a sudden the IPO window and the SPAC window opens up, and all of a sudden you're just seeing massive amounts of new companies in the market. And so, I think there's a in the short run, it makes a lot of sense, given people's enthusiasm to try to take things public, especially if you've done some transformation to the business and margins are higher. You can get some great exit multiples. Now, the hard part's going to be on the buy side. So what in the world are you going to buy, in that environment? Because if the things you're selling are selling, you're getting high multiples for, you're probably going to have to pay high multiple to buy things out. And so that's the really difficult part. And that's why I say that some of the 2021, 2022 vintage private equity funds, I think it's going to be hard pressed for them to kind of put together the returns they've generated in the past. But what I would advise is just and it's exactly what we're doing, is find a business that people think is secularly challenged, but that you have a contrarian perception on, and that you can buy for a fair multiple, or a business that if you broke up the sum of the parts, it'd be worth a lot more than the current stock was trading for. So I think you have to be more creative, and I think you have to be more of a contrarian. And I think that's really the way people are going to make money. And then, as I said in the last part of what we discussed, is like, stay small, right? Bigger deals are going to be more competitive. There's more people looking at them. It's more likely the price is going to be very efficient. And so you're not getting it for undervalued. So, either look outside the US, or if you're doing it in the US, look for smaller businesses that are, don't get the love from public markets. And that's, it's going to be a treacherous environment. I mean, in most private equity, it's a value kind of play, right? You're trying to buy something for less than it's worth. And there's just not a lot out there. So I think you're going to have to be highly selective and just, maybe fewer deals, but, more, put more equity or more of the fund into the deals that you feel most confident about.
Yeah, absolutely. I think the name of the game is value, both selecting and improving value for the companies over time. And I really enjoyed our discussion about how private equity and the public markets are intertwined in a way, and just looking forward to more discussions, Ben. And for our audience, where can they find you? I know you mentioned you had the blog earlier, but are you on social media? Is there how can our audience get in touch with you?
Yeah, I think the best way is to go to covestreetcapital.com. You can find my contact information there. We have a thoughts tab on our website where you can find interviews with me. I've done a number of different podcasts on different subjects. I also write pretty frequently, so you'll see blog posts by me. I don't post on the other side anymore because the SEC does not look favorably upon people who work for investment firms having outside blogs. But I do write pretty frequently for our blog, and you can see the quarterly letters I write as well. And a lot of what we discussed here about what we're seeing in markets is discussed in those letters as well. So, feel free to reach out to me. I'm always happy to discuss this with people. I'm just really interested to see how all of the things that we've talked about, whether they're elevated valuations, whether it's the speculative nature of the market, and then combine that with all of the capital that the private equity firms have raised over the last couple of years to invest into an expensive market. I'm interested to see how that all plays out.
Absolutely. Well, again, it was a pleasure having you on this episode, and we're looking forward to more discussions with you. And take care. Thank you so much.
Yeah, thanks so much for having me on. Really enjoyed it.
Thank you for listening to the Dealmakers Podcast. We hope you enjoyed diving deeper into our guest story and insights on deal making with our host, Ben Claremon. Right now, there is a tremendous opportunity in the mergers and acquisitions space for small and medium-sized enterprises, as it is estimated that in the next 20 years, over $10 trillion will be transferred or lost. To learn more on how to capitalize on this opportunity, visit dealmakersinstitute.com or maspecialist.com.